Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Wyndham stock so we can determine if it's a buy or a sell. Let's get started with the model. This is a mid-cap company, $6 billion market cap. They're trading at $71 a share, and they have 80 million shares outstanding. Wyndham describes itself as the largest hotel franchisor in the world with 9,300 locations. It has a portfolio of 25 hotel brands, including Baymont, Days Inn, Howard Johnson, La Quinta, Ramada, Super 8, Travel Lodge, and Wyndham. They were formed in 2018 as a spin-off from Wyndham Worldwide. Let's take a look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow is really consistent but declining each year, which is not what you want to see. Almost $400 million in 2021, almost $300 million in the trailing 12 months. They do have good margins though, north of 20%. Better than the other lodging companies we looked at. Net income is the profit or loss on the income statement. It's revenue minus expenses. That peaks in 2022 at $355 million. It's lowest in the trailing 12 months, $238 million. Revenue is the sales for the company, and that looks pretty grim. It goes down each year from $1.6 billion to $1.4 billion. They do pay a 2% dividend, which cost them $117 million, which they can definitely cover because their free cash flow is north of $300 million. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's $8.6 billion. We discounted those numbers back to today's weighted average cost of capital. We get a value of the company of $7.8 billion. We divide that by 80 million shares. And we get a calculated stock price of $97. They're trading at $71, so they're trading at a 27% discount. It's a buy according to the model. There are 12 companies in the same industry as Wyndham, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend much in CapEx, a lot less than the average and median. They look a bit leveraged. Their debt-to-equity ratio is 3.3. They do pay the highest dividend, probably because their stock price came down so much. They generate $300 million of free cash flow, which is more than Choice. They rank 6th in market cap. Their price to book is pretty close to the median. Their PE and price to free cash flow are better than the median average, but their price to sales is worse than the median average. Their revenue is $1.4 billion, a little more than the median. Even though their revenue is not as high as these other companies, they're converting a lot of their revenue into free cash flow because franchising is a lot cheaper than owning. So this implies a higher percentage of their portfolio is franchised than these other companies. But their revenue is regressing. Their 5-year annual revenue growth rate is negative 7%. That's the worst on this list. If you put $10,000 into this company when they started trading, you'd be at $13,000 today. That's a 4% annual return. At least you're not down. 2 years after investing that $10,000, you would have been down 50%. That was the COVID bottom in March 2020. Let's take a look at their investor presentation. Here's their claim, largest hotel franchisor worldwide. I don't know if that's accurate, but it sounds good. This is true. They have an asset-light business model generating significant free cash flow. We saw that earlier. They have really good margins. 9,200 hotels, 25 brands. In their pipeline alone, 243,000 rooms. They currently have almost 900,000 rooms in 95 countries and 108 million members. So this is their first quarter presentation slides. Only a 1% growth in global RevPAR. That's revenue per available room. That's not even close to inflation. Net rooms up 4%. Adjusted EBITDA $141 million. Adjusted free cash flow $100 million. And they return $89 million to investors through dividends and buybacks. RevPAR is probably the most common term for lodging companies, hotels and motels. And it's getting worse. It was positive 4%, now it's negative 5%. It's been negative 4 straight quarters. So either they're charging less per room or there's more vacancies. In their international segment, they improved a lot the first 2 quarters of 2023. The improvement has slowed down. Their net room growth was pretty high in 2024, 15%. Only 8% in 2023. But their RevPAR is going down, so I don't know if that's such a great figure. Retention seems to be going up. It's 95.6% in the first quarter of 2024. They have a pretty big pipeline, 1,980 hotels with 240,000 rooms. So a lot of growth in the future. A little more than half is international growth, a little less than half is US growth. 79% of their growth is new construction, new hotels. 21% is upgrading their current hotels. And the majority of the pipeline is mid-scale brands. 17% economy, high-end Echo Suites is 14%. They're getting close to opening their Echo Suites. Here are their 6 locations: Richmond, Virginia, Spartanburg, South Carolina, Plano, North Texas, Katy, Texas, Indianapolis, and Plano Gateway in Texas. Their adjusted EBITDA was $141 million. They converted 70% of that into adjusted free cash flow. The difference between $141 million and $102 million is $39 million. Most of that is interest expense, $28 million interest on their debt, $9 million capex, investments in property, plant, and equipment, and then working capital. Working capital is current assets minus current liabilities. They're the largest hotel franchisor in the world with 9,200. Marriott 8,900, Hilton 7,600, Choice 7,500, IHG is 6,400. But I've told you in prior videos, you can't compare the number of hotels. That's not a good metric. You have to compare the rooms. Because if I own one hotel and you own 10 hotels, it doesn't mean you have a bigger portfolio. My one hotel may have 1,000 rooms, and each of your hotels only has 10 rooms each. So mine is much bigger. The reason Wyndham has low expenses is because they franchise 99%, actually more than 99% of their hotels. So does Choice. I didn't know Choice did it also. 71% of their guests are for leisure travel. Then second is infrastructure, 22%. I like this term, corporate transient. Those transients, just throw them in a basement. Our domestic guests are middle class and getting younger. That sounds very predatory. The average household income for their guests is $95,000, 30% higher than the US median. 87% of their hotels are in drive-to locations because you can't put a hotel in a really remote area where people can't get to it. You have to be able to drive to it, and you can't spend hours and hours driving to it. It has to be within like 20-30 minutes, or you just find another hotel. And pretty much all their guests are from the US. Very few outside the US. Look how much they cover the US. Pretty much every single state they have covered. They're really concentrated on the East Coast. A pretty good concentration in California as well. It looks like they have some locations in Mexico. Their focus is select service, not full service. 99% of their hotels are select service. Marriott, 71% is full service. Obviously, it's a lot more expensive for full service. If you want to be a franchisee, here's some information. You have to build the hotel. That costs $75,000 per room. And they're assuming you would get a loan, your LTV will be 70%. LTV is loan to value. It's the loan amount over the value of the real estate. You need to invest $1.6 million. Revenue per available room is only $55. Annual revenue for the year is $1.4 million. OPEX, $770,000. Royalties, or brand fees they call it, $119,000. And they assume you take a loan at a 7.25% interest rate. So your interest expense is $266,000. EBITDA, $247,000. Cash on cash return, 16%. Seems like a decent return. Here's a visual of their brands. Their economy, their least expensive, Days Inn, Super 8, Howard Johnson. Then you have mid-scale like Ramada and Baymont. Upper mid-scale La Quinta. Upscale, Wyndham, Vienna House. That does sound pretty upscale. Upper upscale, Wyndham Grand and Dolce. And then luxury, Registry Collection Hotels. This is like the Ritz-Carlton type. So their revenue is royalties and franchise fees. In addition to franchising, they license, and other revenue, $177 million. So for 2023, total fees and revenue, $1.4 billion. 48% margin, really high margins. Adjusted EBITDA, $659 million. To get the 48%, it's $659 over $1384. They convert 48% of their revenue into adjusted EBITDA. And we did see really high margins when we looked at their financials earlier on my Excel file. Their net income for the first quarter of 2024 is $16 million. For all of 2023, it's $289 million. Adjusted EBITDA in the first quarter, $141 million. For all of 2023, $659 million. So if you annualize the 141, multiply it by 4, that's 564. So a little less than 2023. But if you annualize the net income, that's only 64, a lot less than all of 2023. Really good margins. Operating income margin, 36%. That's operating income over revenue. Depreciation and amortization is 5% of their revenue. Adjusted EBITDA is 81% of their revenue. And their operating cash flow is $76 million. That's the first quarter. They invested $24 million, $67 million in financing. That includes dividends. Free cash flow is operating cash flow, the $76 million, minus CapEx, $9 million of CapEx. There was a payment of $31 million, development advance notes, because they get paid a development fee for building the properties. Development fee is like 5 or 6% of the total project. They don't put in the capital to build the project. The franchisee or the licensee does that. But they do get paid a development fee for organizing it and getting it done. It's not easy to build a hotel. So their adjusted free cash flow is $102 million. The only reason I know this so well is because I just started working for a real estate developer. I've been there 5 weeks. I learned a lot already. Let's take a look at the company on Simply Wall Street. Its last price, 70, 5.7 billion market cap, down 1% in the past week. Pretty much flat in the past year. Let's see what they say about the company. Wyndham is a franchisor in the US and around the world. They operate through two segments, hotel franchising and hotel management. They license their brand name and provide related services to hotel owners. They provide full service international managed business services. They're involved in the guest loyalty program business. Their portfolio includes Super 8, Days Inn, Travelodge, Microtel, Howard Johnson, La Quinta, Ramada, Baymont, American, Wingate, Wyndham Ultra, Wyndham Garden, Ramada Encore, Hawthorne, Trademark Collection, Trip, Wyndham, Wyndham Grand, Water Walk Extended Stay by Wyndham, Dazzler, Esplendor, Dolce, Vienna House, and Registry Collection. Incorporated in 2017, headquartered in Parsippany, New Jersey. Here's their stock price since they started trading in 2018. They started out at about $60, and their lowest was from COVID, $25. They did get close to $90 at the end of 2021 and beginning of 2022. But that was their peak. That was a bad time to buy it, because 2 years later, they've come down to 70. I think this may be a good time to buy. The stock seems a little more beaten down than the other lodging stocks. Simply Wall Street's valuation is 86. They say they're 18% undervalued. 13 analysts priced this stock at $90. Their revenue forecast for 2024 is $1.45 billion, 2025 $1.5 billion, 2026 $1.6 billion. 2024 free cash flow projection $413 million, 2025 $427 million. Their revenue back in 2015 was $1 billion. It peaked in 2019 at $1.4 billion. It's not quite there yet. It's still below $1.4 billion currently. The other lodging companies seem to be higher than 2019 levels. They're still trying to catch up. They had almost no debt in 2016 and 17. They did add some debt in 2018. It got to $2 billion. It peaked in 2020, almost $3 billion, but now it's down to $2.2 billion. This blue line is their equity. They always have positive equity, but it's been lower than their debt the past few years. Equity of $700 million, debt of $2.2 billion. They have very little cash on their balance sheet, currently $50 million. Their next dividend is June 27th. The ex-dividend date is June 13th. So you want to own the stock before June 13th to get that dividend. Their dividend yield peaked at 3.7% in March 2020. They cut their dividend, and now it's around 2%. The forecast is 2.5% by 2026. The CEO's salary went from $700,000 to $1.1 million. Total compensation, $11 million. Tenure as CEO, 6 years. In the past year, 1 insider sell, no buys. 93% of the company is owned by institutions, 5% by the general public, and 1% by insiders. Vanguard is the biggest shareholder. The LA company Capital Research is second at 10%. Then BlackRock, Wellington, Boston Partners. The San Francisco company Jackson Square owns 1.3%. Citadel 1%. Wall-E Capital, the New York City firm, 0.8%. Look at their employee count. It peaked at 16,000 in 2018, but they've just been focusing on franchising, so now it's down to 2,300. And the ticker trades on the New York Stock Exchange, Deutsche Börse, and London Stock Exchange. So let me know what you think. Give the video a like, subscribe, or comment below. If you're looking to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.